Are you or someone you know looking to buy or sell a home? When you use a HomeGain Realtor to buy or sell a home, you can get $150. Visit HomeGain.com and click on the Promo 150 banner at the top of the page to get started. Compare HomeGain Realtors and choose your favorite. Complete your home purchase or sale transaction with a HomeGain Realtor, and HomeGain will pay you $150. Get started today by going to HomeGain.com. Welcome back, everyone, to Real Estate 360 Live. I'm your host, Ryan Sloper, joined today by my guest, Louis Cammarosano, the general manager of HomeGain. Quick reminder, the show is designed to build the Washington, D.C. Metro's housing and credit markets by giving you good free advice. If you ever have any questions, concerns, or real estate needs, the best number to reach out to us is 877-245-2030. That's 877-245-2030. Or visit us via the web at realestate360live.com. That's realestate360live.com. So I've had a lot of emails in and questions, voicemails from listeners on, qualifying for a mortgage. And obviously we know that it's very difficult out there to get qualified for a mortgage. We'll go in probably in the next 15 minutes. We'll jump into, how actually more purchase applications are getting approved than refinance applications and why that's the case. But as if it wasn't hard enough to get qualified, now what they've done, and this has been going on for a while now, probably about 6 months to a year, Fannie Mae has instituted what is considered a loan quality initiative. And it's in a broadened scope. It comprises of basically nine pages, and it's for all the banks, because basically, Fannie Mae and Freddie Mac, they buy up all the loans from Wells and Bank of America, all the big lenders. So what it's doing is it's creating extra steps for the banks in its underwriting process, and it's it could be validating Social Security numbers and the borrower occupancy, small things. But one of the major things that's required is that right prior to closing, they're going to pull your credit report again. Okay, now while this is a very, very, very big deal, and the reason why is it could actually change your loan terms. The way the process used to work was that you would apply for a mortgage, they would pull your credit, the loan would then get underwritten and approved, and then if after that it would be clear to close and the loan would fund. Well, now you apply for that mortgage, you get your credit checked, it goes to an underwriter, they approve the loan. Then it sits in this basically like a pre-closing department where they then check your credit again. And that has to come back and everything be okay before they'll actually fund your loan. So now the reason why they're doing this and this initiative by Fannie Mae of what they're trying to, weed out is they want to see, did you apply for any new credit cards while your loan was in process? Did you run up any existing cards while your loan was in process? Did you finance any automobiles or any other type of loans? Did you add any non-disclosed debts while you were in the loan process? So basically, they figure that if you already had your credit pulled, that you've been approved, that you're going to go ahead and just get that loan. And it's not as simple as that. I know a lot of people are running out to get furniture on credit cards. You don't want to do that. Okay, because what that can do is, number one, it could change your debt-to-income ratios, because now you have more debts than you originally had when you originally applied for that loan. So it could actually adversely affect where they could just decline your loan because now your debt-to-income ratios are too high and you don't qualify. So, that's one of the biggest things there. You also making sure that, you continuously paid your bills on time, that you didn't miss any payments between the time you started. I know that a lot of these things sound simple, but, one little slip up from the time that you originally applied and then right before closing could cause your loan not to go through or to have higher interest rate. So it would basically your overall cost of home ownership would go up. So what can you do? What can you do to make sure that, you're not going to fall victim to this? Well, basically, don't try to obtain any new credit at all while in the midst of a mortgage application, okay? Until you've signed on the dotted line, you've closed and got the keys and you've moved in, it's not even worth, seeing if you can apply for a credit card, even though you may not use it. Don't even do it. I know many might just go out to Best Buy and say, hey, I'm going to buy a 50-inch TV, but maybe I'll just apply for the credit card, see if I can get 0% interest, and then buy it later. Don't do that. Okay? Because if you do and the credit's pulled, it gives them grounds to deny your loan. and or change the terms of your loan. So, as if loan approvals weren't tough enough, it seems like it's almost, for a lot of people, it feels like it's becoming impossible to get a loan. Lewis, this is the frustration of a lot of people. It's kind of like, they're told initially that their loan has been fully approved and they're ready to go. And then all of a sudden it goes to this, basically a compliance department where they're going to check again. And everybody thinks that everything is clear and ready to go, and it's not. The big deal here, guys, is that, they're looking for reasons to turn down your loan. Now, they may not come right out and say that, but they want the cream of the crop. They want those, high 700-plus credit scores. And so, if your loan has anything, they call them like scratch and dent loans, where Fannie Mae might not buy that loan, then they're probably not going to approve it because they're not going to get stuck trying to hold and service that loan. They want to sell it. If they can't sell it, then they probably don't want it. So the smallest of things can actually, ruin your chances of obtaining a home loan, buying a new house. This is one of the biggest things that I've seen lately that's caused people a lot of heartache when they find out that they're no longer going to get a home because they went out and either, refinanced a car or, like I said before, took out a new credit card and put furniture or TV on there. It's pretty simple. I do know that a lot of loan officers out there or other mortgage professionals are not necessarily letting clients know, hey, this is the way that things go. So I think it's important for our listeners out there, just because you made it through the initial qualifying stage of getting approved for a mortgage, don't think that it's the end. Until you sign on that dotted line, things are not over. 877-245-2030. That's the number. If you have any questions or concerns, if you're wondering, why things are the way they are, we're glad to try to send you, the actual underwriting guidelines that kind of lay out these things. Next, I wanted to transition. It's kind of on the same topic, but, it goes along the same lines of, applying for a home mortgage. And Ellie Mae had actually done some statistics on the amount of mortgage applications that have been denied. And believe it or not, more purchase applications have been approved and actually gone to the table versus refinances. And the reason why this is probably the case is because, there's a lot of the home affordable refinance programs, basically all the different four-letter acronyms that was put out by the government, different programs that were supposed to help people that are upside down in their homes. So you can imagine that the guidelines are a lot more stringent on those type of loans. But for July of 2012, Ellie Mae reported that 45.8% of all loan applications reached the settlement table, which is a 0.4% drop from the month prior and a substantial drop from November of 2011, which was the first month that the software firm tracked this type of data. Now, that means that basically fewer than half of today's mortgage applications are actually closing. That number is pretty staggering. Wouldn't you agree, Lewis?
Absolutely.
I mean, half. That is absolutely crazy to me. You would think that it would be at least like 60% or something like that, but we can't even get 50%. They're saying, the purchases approved rate was 58.7% of all the applications that were approved. Now, granted, this is just Ellie Mae's software, which accounts for about 20% of all U.S. mortgage originations, but I still feel like that's probably a pretty good sample size to determine, what's being approved and what's not. The refinance approval rate was 37.9% of all applications approved, which was down from 38.9%, so it's actually getting worse.
Who wants to loan money at those rates? I mean,
yeah, and so, you can really see that these guidelines are becoming more stringent. They're really, crossing every T and dotting every single I that's out there to make sure that this is the best type of borrower that they can turn around and sell that loan and not have to take a loss on it.
It's a gift if you can get it, and that's why they're making it hard to take.
Yeah, and people will be like, well, I don't understand. I have my W-2 here. I make good money. And it used to be you have good credit scores. You make solid money. You're going to get a loan. Unfortunately, now it's okay. Not only do you have to do those two things, you're going to have to document your tax returns. They're going to verify them with the IRS. They're also going to look at your bank statements. They're going to make sure you don't have any unknown or large deposits over $1,000, and they're going to ask for documentation of all those things. If you can't provide those things, then it's grounds for denial. So, what all this really means is you need to be working with a professional that really knows how to navigate these waters, that can look at it and, just because the statistics are saying that, basically half the loans are actually making it to the closing table doesn't mean that that's the case for everybody. I mean, there's some great mortgage companies out there that are approving probably, anywhere from maybe 75, 80% of their loans. But a lot of it has to do with how they put those loans together. Are they packaging, putting a detailed letter of explanation to give the underwriter a great idea of what's going on with that file? Many people probably just put them together, throw W-2s in there, and let the underwriter try to figure out what's going on with the file. And right now, they need all the information that they can possibly get, because less than 50% of loans are making it to the table. That doesn't even seem right at all, because I know that majority of people, when they initially apply for a loan, probably think that they do apply, or they do qualify, even though they probably don't. But that doesn't mean that, these statistics should be holding true. And I really think that I want to urge people to also get second opinions. Don't always take that, that first answer and assume that it's the end of the road. I work with a company. They're great, Gold Star Financial. They actually was one of our listeners that had called in, and they had been turned down for 2 or 3 other different places and went to Gold Star, and they were actually able to navigate and put that loan together and get it done. Now, is that going to be the case for everybody? Not necessarily, but what it does show you is that there's different ways to look at things and put things together. And I feel like that, now more than ever, you need to be working with professionals that can give you, that trusted advice that can really increase your chances of going to the closing table. I mean, it's got to be better than basically less than half. 877-245-2030. 877-245-2030. When we come back, I'm going to let you know Bank of America is donating thousands of homes to vets. Curious as to why they're doing that. Next, when we come back.